Thanks, Vyrona, and thanks Hong Kong Association in New York and Northern California for putting all this together. And I work mostly with small to mid-sized international companies in manufacturing, wholesale, logistics, real estate, technology industry. Most of them are within a large international control group. So as Connie has covered the outbound piece, today I would like to talk about the inbound piece. So such as things to consider when structure the inbound business, and I will provide some updates on PPP and ERC credit and FFCRA credit. A few minutes to talk about the mid-year tax planning idea. So Aprio is one of the top 50 accounting firms with more than 600 team members, and 20% of the firm is actually foreign born. And we serve happy clients from more than 50 countries. So when considering what is the best type of entity for your inbound business, we usually will evaluate the tax implication from a holistic standpoint. We're not just looking at the federal tax, international tax, withholding tax, but we also look at the state income taxes and some of the non-income taxes. So also when we plan on the structure, we look at the industry and what type of industry you are in, and what activity you're going to conduct in the US, active or passive. And we look at the full cycle of the business and look at the exit strategy and repatriation of earnings. So a lot of time, the foreign owners would prefer to set up a C Corp for their US manufacturing and wholesale business for mainly the purpose of separating the legal liability. And also they don't want to deal with the permanent establishment issues if there were a US partnership was set up. However, we also have seen foreign passive investors would prefer to set up a US partnership to hold their passive investment in the US. So there's a lot of choice and a lot of consideration. And in structuring the inbound business, the withholding tax plays an important role. If a parent company comes from a non-income tax treaty countries or jurisdiction, withholding tax rate is 30%. So the cost of repatriating the money back to the parent company is pretty steep. So to mitigate these issues, we assist the client to look at their overall global structure and utilize the other existing active subsidiary in other treaty country to hold the shares of the US sub, such as using the UK sub to hold the US sub share. As the Green Book, the Biden proposal, tax proposal was just announced last month, I think now might be a good time to reconsider your choice of entities. Because the Green Books propose various rate increases, including a corporate tax rate, individual tax rate, long-term capital gain rate, qualified dividend rate, and also, like Connie just mentioned, they doubled the duty effective rate. However, there's some good news though. The Green Book keeps the few favorable deductions, such as the 1998 deductions, to make the flow-through entity might be more attractive now. However, on the Green Book, they also propose one provision, and probably a lot of the people might overlook. The proposal says they will put more flow-through income to subject to the net investment income tax and self-employment taxes. And also the Green Book proposed a limitation on foreign tax credit for sales of hybrid entities. That would actually affect a lot of inbound business with a foreign operations. So those potential tax implication of all this needs to be carefully evaluated before you actually structure the business. And we have seen that some multinational companies set up their US operation by product or service line. So each US entity is like a brother sister of another, and they don't file consolidated return because they don't have a US common ownership. So this type of brother sister control group oftentimes face unfavorable tax consequences because the tax attributes of the US component entity will be trapped within the group, and they share the same tax limitation as a group. And while the income of one component entity cannot net with the other entity's loss. So consider to aggregate the broader sister company into one US common ownership, because that usually the straightforward parent sub structure would generally bring in more tax advantage. There are more to cover. So be aware of the adverse tax situation when you sell a partnership that owns a CFC with the undistributed earnings and profit. I mean, I run into this situation a lot of time, and the CFC would be considered indirectly sold, and all those undistributed earnings and profit in the CFC will be treated as an ordinary income. And the ultimate US individual partners of the partnership will be taxed at the ordinary tax rate, and no foreign tax credits would be allowed. Well, there will be some solution to mitigate this situation. So just keep that in mind. So it becomes more and more common that the inbound business have foreign operation or set up a CFC, the control foreign corp, as the economy is more globalized. Just like my client, they're a foreign-owned US company, but have operation in Northern America and Latin America. So just be mindful when structure those business, or when you try to reclassify the foreign entity for US tax purposes. I'm not trying to go through a list of the things to consider when structure the business. Is very complicated. There are numerous factors to consider when structure the business. So I'll just jump into the ERC very quick. So I presume the audience are familiar with the ERC. So I want to touch base on a few things. First of all is the affiliation rule. The ERC affiliation rule is different from the affiliation rule applied to PPP. In a parent sub situation, if the ownership is more than 50%, the parent sub will be considered one employer in ERC qualification test and the calculation. And if an individual or trust ownership structure, then 5 or fewer individuals and trusts own more than 80%, then the affiliation group will be considered as one employer. And we receive a lot of questions from the client regarding whether to include a foreign parent company when we qualify the ERC and doing the calculation of the credit. So foreign parent company will be excluded for ERC purposes because non-US employee will be eligible for ERC, and the foreign gross receipts will be excluded in the gross receipt test calculation. So therefore, we take a position that the foreign companies will be excluded. Since there's no double dipping on the benefits, so same wages cannot be used in 2 places. So practically, we will apply the qualified wages to PPP forgiveness and the FFCRA credit first, because those are dollar to dollar. But beware of the interaction of the R&D tax credit and the WOTC credit. Tax treatment. The credit will be claimed retroactively as a refund on the amended payroll tax return, but prospectively, the credit can offset the Form 941 liability on the current quarter payroll tax return. And any excess will be refunded. The IRS is very slow on processing their ERC refund claim. So therefore, the current ERC claim, the Q2 ERC will try to claim the Q2 on the current Q2 941. So the taxpayer would get the instant benefit. Keep that in mind, the wages deduction will be reduced by the credit amount. So in other words, the credit is taxable. IRS has not issued a clear guidance on the timing when the credit becomes taxable. And also the states are still going through the legislative process to either depart from the federal tax treatment or conform with the federal tax treatment. I'm gonna skip the FSCRA credit. Anyway, it's got extended to September 30, 2021. As the pandemic still ongoing, I think more and more taxpayer becomes eligible for the FSCRA credit and benefit from the credit. So let's jump to the mid-year tax planning very quick. So the COVID and the new administration brought a lot of challenges in tax planning and the compliances, but I believe at the same time, it brought in some opportunities. So make sure you maximize all the benefits that provided by the 3 tax bills passed during the COVID. So maximize the PPP loan forgiveness and the credits. And if someone in the audience working in the hospitality industry, and make sure you apply for the restaurant revitalization fund grant and maximize the NOL carryback opportunity provided by the CARES Act. There is some strategy that we can apply, like changing some accounting methods and change the transfer pricing policy to maximize the NOL carryback. And profit sharing, I think a lot of people overlook this beneficial provision. So if you have not filed the 2020 tax return, consider establish a profit sharing plan for 2020 and make contribution to the plan. And take a deduction and save income tax. And then the next couple slides, there are some small tips on saving the taxes. And I'm not gonna go over it, but keep in mind, small things does add up. So don't overlook some looks like a small items, but at the end of the day, it might bring you some good surprise. So there are 2 TCJA provisions will go effective on 1/1/2022. And one is the R&D expenses, starting 1/1/2022. R&D expenses are required to be capitalized and amortized over 5 years. If R&D expenses incur outside of the U.S., we're required to capitalize and amortize those foreign R&D expenses over 15 years. So this requirement might turn the loss situation to a profit situation for lots of technology company. And also if the CFC is responsible for R&D development, and we'll recommend you to review the intercompany payments related to the foreign R&D activities and evaluate the impacts of the capitalization and also the impact on the PT tax calculation. There's another provision actually go effective starting 1/1/2022, which is the interest expense deduction limitation is calculating based on 30% of EBIT. Means the depreciation and amortization will not be added back on the base. And that means less interest expense would be allowed to be deducted. Let's see. And in lieu of the Green Book proposed more limitation on the interest deductions on multinational group, such as the members' interest deduction is limited to the sum of its interest income and 10% of its 163J, which is the interest expense limitation, the adjusted taxable income, the EBIT. There's sunset rules in TCJA, and most of them are individual tax provisions. So if you have a pass-through entity and you try to project the company's cash flow and the individual owner's tax liability for the next few years, and make sure you consider the 2025 sunset provision and also the potential tax law changes. There's one thing that on the bonus depreciation, starting 2023, bonus depreciation percentage will be reduced by 20% annually until it turns to zero rate in 2027. So keep that in mind when you try to project your company's budget. You either accelerate the deduction or making an election for the bonus depreciation or opt out. So transfer pricing, the 2020 and 2021 COVID years actually make the profit different from the other years. So we recommend you to review your transfer pricing policy. So companies using profit-based transfer pricing methods need to re-examine how they're applying their methodology immediately, especially those are experience a change in profit due to pandemic. So if you have excess foreign tax credit, you might want to review how your income is currently sourced and make appropriate adjustment and classification and boost the foreign source income. And multinational companies are encouraged to examine their current structure and determine if there's a more advantageous structure that can be used. And it's very complicated tax code and regulation that we are dealing with. So a lot of the multinational company may not prefer aggressive changes on the structure. In this case, I will recommend them to proactively manage the global effective rate and monitor closely on the activities and run the planning models and make flexible modifications. So I particularly put flexible means there's a lot of uncertainties on the new tax law changes, and also the political factors also, it's really bringing a lot of uncertainty. So I'm not trying to run an exhausting tax planning list today, but hopefully my presentation provides you some valuable insights. Thank you so much. Back to you, Winona.